Hey everyone, this is Lawrence from financialthing.com. I've stumbled into the offices of Landbay today here with the boss man, John Goodhall. Going to ask him a little Q&A about where Landbay is and some questions that were actually submitted by you, the readers, that you wanted answered. And John's going to kind of go through them quickly with us. So thank you, John, for doing this. Appreciate you taking your time from your busy schedule. Let me ask you, tell us when Landbay was established.
Well, thanks a lot. It's a pleasure to be here and talk to your readers and listeners. So we started the business in 2013 in terms of set the business up. We didn't then launch it till 2014. And yeah, the first loan was completed beginning of July 2014. And we're sitting here obviously in January 2019. So we've been now lending for 4.5 years.
4.5 years of good quality loans too. By the way, I just want to say that I am also an investor personally through Landbay's loans. Just as a disclosure to put that out there, I've been investing for a few years now. So John, we've got this uncertainty of Brexit that's obviously burbling along right now. Where do you see the UK property market heading in 2019?
So the UK property market over the last 2 years has been quite a strange one actually in many respects, in the sense that traditionally what's happened in UK property is that London, and to a lesser extent the South East, has generally grown at a faster rate than the rest of the country in terms of prices. And the same might be true for rents as well. To a lesser extent. So over the last 2 years, and actually it's not just down to the Brexit referendum, there's been some change in the stamp duty regime in the UK that actually was introduced 3 months before the Brexit referendum. So a lot of the data that people look at, they put it all down to the Brexit referendum. The stamp duty had a material impact in terms of making more expensive houses even more expensive, which obviously impacted London more. But so over the last 2 years, the sort of usual rules haven't applied, and we've seen areas outside of London South East, particularly the Midlands, so Birmingham, but also the East Midlands, Nottingham, Leicester, Derby, etc., growing at a far faster rate than that of London. And actually, London has broadly speaking been flat. It does depend exactly where you are in London and boroughs. Central London certainly has been down, outer London has been slightly up. We suspect that's likely to continue regardless of Brexit actually. Whether Brexit is sort of hard or soft, we still see the London market to be relatively soft, if that makes sense, so not material growth. But actually outside of London we still think that there's room for house prices to grow. Obviously in the UK, we're starting to see wage inflation tick up, which in many respects is a good thing, i.e. Earnings are rising faster than the cost of housing, and where that housing is rental buying, which is a good thing for the economy. One thing I'd say is, and people don't always believe me when I say this, is buy-to-let is not really a property play. So the people we're lending to are fairly small businesses that rent property out. And those people are not looking necessarily to make a profit from selling the house. They don't need to sell the house, they're long-term investors. And so it's more linked to the rental market rather than prices. And certainly landlords that we've spoken to actually have become buyers in London over the last year as property prices have fallen. By definition, yields and therefore the returns on property have actually improved. So while falling property prices would affect things like development lending and bridging lending, where people need to sell a property at the end of the loan, in buy-to-let they're not looking to sell, they're buy and hold investors. Yeah. And so actually they see a downturn as an opportunity to buy, if that makes sense.
Right.
As long as rent's holding, which they are.
Yeah.
Sorry, that's a rather long answer.
How is Landbay positioned to weather the Brexit storm? Is it really going to affect Landbay that much, whatever happens with the Brexit?
We don't think Landbay will be that affected by Brexit. I mean, it's obviously hard to tell. No one really knows what's going to happen to either Brexit and therefore what's going to happen to the UK economy over the coming years. But buy-to-let mortgages are not that impacted by property prices in terms of credit performance, if that makes sense. And the thing that drives it is rents. Can a landlord rent out a property and make a profit from that rental property? If he or she can, then they're going to pay their mortgage in simple terms. regardless of what's happening to the property price in the background. On average, our rental coverage ratio is 180%. So for every £1,800 that the landlord is receiving in rent, their mortgage payment is £1,000. So there's a decent buffer there, and most of our landlords are portfolio landlords. They have 3, 4, 5, 6 properties. So even if demand drops off on that rental portfolio, if, for example, they've got 5 properties, 3 properties on average should pay for the mortgage on 5, if that makes sense. And obviously it does enable them to cut rents or rents to fall, which doesn't happen that often. And to put it in perspective, in 2008, 2009, rents fell about 1.5% on average, whereas obviously house prices fell by 20-25%. So rents are a lot less volatile than property prices. So we think we'll fare pretty well. Our average loan to value is 70%. So even if things do turn hairy, we've got quite a lot of the borrowers have quite a lot of skin in the game in terms of equity.
So you don't think it'll affect you that much? Question I get asked all the time, John: profitabilities of companies in peer-to-peer spaces. A lot of people running in the red. What about Landbay? Are they profitable right now?
So in Q4 of last year, we were profitable for that quarter. We weren't profitable for the entire year. We've, to put it in perspective, we've doubled the size of the team and moved offices in the space of the last 12 months. So we're now 60. We were 32, I think, at the beginning of 2018. But still, as we've grown, we've actually narrowed losses, and I say we've actually made a profit. And a 6-figure profit in Q4 last year as we've grown originations. This quarter, I suspect, will be slightly loss-making, but then we'll re-enter profitability again going forward, and we'll be profitable for every other quarter in 2019 and for the year as a whole.
You know that in peer-to-peer lending, a lot of the problems that companies have is the balance between having enough lender funds and having enough loans to keep that balance. How do you manage that difficult balance that companies face?
Well, we have a lot of institutional funders who invest in our loans, and we think that's a good thing for retail investors. And the reason why is these are PRA regulated banks on the main. There are some non-bank institutions too. And they've been in and done extensive due diligence on our credit processes, our servicing, our legal documents, our valuations process, every single thing. And they obviously have the right to audit some of our loans too. And so hopefully that should reinsure retail investors that actually they're investing alongside in the same type of loan that institutional investors are investing in. And there's no cherry picking of loans. We allocate the loans at random to retail or institutional. And so because of that, our institutional funders will fund as many loans as we can find them. And so for us, the barrier is around origination. So if that makes sense. So if we could double our originations overnight, then we'd grow we'd double our lending volumes. And we are growing it. And obviously mortgages it takes time. Obviously a mortgage takes anywhere from 2 to 5 months to complete. So we know that, for example, this month, Joe, we're sitting in January, it's towards the end of January, we suspect we'll finish the month on about somewhere between 20 and 22 million of lending for this month. And at the same time, we know that in April, based on our pipeline, we should be at least 50% ahead of that, if that makes sense. And we know we have funding for those loans. So through 2019, we expect to grow. And because we have institutional investors, we don't have to overly worry about that balance and whether we can fund them, if that makes sense. Which again also gives reassurance to borrowers that actually, when we give a mortgage offer, we're good for it.
Yeah, that's a nice problem that you've had solved. A lot of people in peer-to-peer as lenders are having some concerns about being sued from outside borrowers. There's been a couple of there has been one case that this has happened. So I get asked a lot, what does a company like Landbay do to protect lenders against personal legal action from a loan borrower? Now, as I understand, I don't think you quite have that issue because your setup is a little bit different. But if you could just tell quickly how, lenders could be protected, or how they can feel safe relatively against it.
So firstly, I don't know the details of that case. Obviously, I've read about it, but I don't know the details. I'm not a lawyer, so I don't know the merits or not of that case. We allocate loans to investors on their behalf. We act as their agent. We don't disclose names on loan docs. We act on our loan docs state that Landbay is a agent for other investors, lenders. All those dealings are done from the borrower, whether it be the borrower or their brokers, their advisor, are done with Landbay, and that is true whether it's an institutional investor or retail investor. They come to us and we deal with it. I don't understand how a borrower could have any right to sue us for anything. We're operating in an unregulated space, so it's not like we'd be in breach of any consumer lending rules in that sense, which would be they'd be dealt with by an ombudsman. And if there are any costs attached in terms of enforcing, and to be clear, we in 4.5 years we haven't had any defaults to date. But if there are any costs, we have a separate ring-fence fund that would cover those costs of enforcing on property, and it would be done in Landbay's name, and we have the full right to enforce as we see fit for borrowers' benefit. We wouldn't be taking polls on what we should do on a certain thing. And again, it's a different form of lending. We are dealing with a property that is either rented out or in a state to rent out, and so it can be sold relatively quickly. In other areas of property lending, you have a situation where a property might be halfway through a development, and therefore you've got to take a decision of, do we enforce? Right. If we do enforce, it has impacts for the borrower, but actually in what we're doing, it is more vanilla in that sense and more straightforward. That fundamentally, if the borrower has missed multiple payments up to a certain point, firstly, before we even enforce, we can get the rent paid directly to us, so we can service the loans. We know there's cash flow to support the loan, and then we can take time to decide what to do, whether we do enforce, whether we do sale, or not, if the case may be.
Just if you could just answer this very quickly, but a lot of the problems also that we see in peer-to-peer lending are the valuations that are being put forth on properties, and especially with developments, which you really don't deal with. But what happens we're seeing is when these properties go into default and they're being sold, the recoveries are far less than obviously the projected values of what the properties are worth. How do you address making sure that the valuations of the properties that you're lending money towards are accurate?
Yeah, so one thing I'd say about that, first and foremost, in valuations is it is not an absolute science. So the valuation is an opinion at the date of the valuation, if that makes sense. So obviously when you come to enforce, the environment might be different. And obviously if you have a 2 or 3 bedroom property in a city, you have lots of data points where you can say, well, actually, in very, very similar properties over the last year, this is what they sold for. There's quite a lot of activity in terms of buying and selling. So you can sort of say quite accurately, probably plus or minus 10%, but you have a band which you can have quite a lot of confidence about at that point in time, and that's the key thing. It doesn't mean that in a year's time it's going to be worth that. It may be worth more, it may be worth less. Obviously, I think where you get into problems with valuations, and which I don't think people realise or is understood, is valuing a 3-bedroom property in Birmingham where you have hundreds of thousands that are similar, maybe 50,000, is very different to a commercial property in a non-urban area where the comparables are not the same. So when you're actually looking at data and thinking, well, actually, how do we value this? What else has sold recently? And there's nothing in the same area that has sold over the last year or two. It becomes a lot more judgmental and a lot more of an art. Okay. And also, by the same definition, if you sell that property, there's not going to be thousands of potential buyers. If you're selling a 3-bedroom property in Birmingham, there are potentially thousands of buyers for that property, so you have a genuine market in terms of where supply and demand works. Once you get into commercial areas, development areas, other sort of niche types of property, you don't have that sort of certainty around the accuracy of valuation. So, valuations are never by definition 100% accurate. They can't be. But as soon as you get away from more mainstream types of properties and away from urban areas, the smaller the area, the less buyers there are, and that's what you've got to think about. The more potential buyers there are of the property, the more accurate the valuation in very simple terms.
Right.
And also, we value our properties in actually really three ways. One is, what would it go for today? What would it be at a for sale? Which may or may not be it may be at the same price. It may be at a discount, and obviously, if it is in a remote village, it would be at a more of a discount than if it's in Birmingham or Manchester. I don't want to pick on Birmingham. And also, we look at rental data. So because we've got, we're trying to first and foremost work out what we think it can rent for, and so a lot of our valuations are also based on yield, and that for us, from a credit point of view, that's the bit we really want to get comfortable with. Actually, what can you rent it out for? Because if that supports the mortgage payments, and obviously in development and commercial properties, that's again sort of harder, if that makes sense.
Right.
So there are a number of things you can do. There's a lot more data, but the data, I think it's useful for 1, 2, 3 bedroom properties in urban areas. Once you move away from that, you've got to apply a discount to that, really, and sometimes that discount might be as much as 20-25%. It's not just say 5% off.
Yeah. I think a lot of lenders too, especially newer peer-to-peer lenders, they don't realize how much difference that could be in a valuation, like you say, what the property actually gets sold for in default, because they just don't have enough experience inside the property market to know how that system works and what the risks are. Valuation is just an opinion, and it could go either way.
Yeah, and particularly when you look at, for example, when you look at new build properties, there's a bit more risk there because you don't know exactly what that value is. And if you look at the data, commercial is more volatile. It's one of the reasons why, generally speaking, on commercial properties, mainstream lenders would not lend at as higher LTV as they would on residential, and that's because of uncertainty around the valuation. So, if you're uncertain about the valuation, you trim back the LTV because of that uncertainty. It doesn't mean you've got more. Bizarrely, people think, it's only at 70%. I've got more security than 80% or 75%. Not necessarily.
Yeah.
The reason it's low LTV is because there's less uncertainty of that, the actual value bit, if that makes sense.
Yeah, absolutely. So, John, I always ask the company heads about this, because everybody has their own opinion on what they think the risk of their company is. So if a lender was coming to you and saying, if I invest through Landbay, on a scale of 1 to 10 risk-wise, 10 being the riskiest, 1 being the least risky, within the peer-to-peer and crowd lending space, where do you put Landbay on that risk scale, in your opinion?
Yeah, obviously? I mean, definitely the lower end. I mean, we've been in for 4.5 years. It's secured on residential property, buy-to-let. If you look at buy-to-let data through the credit crisis in terms of arrears and losses, you're talking, even in 2008, 2009, in terms of losses, you're looking at fractions of a percent in terms of losses in 2009. For sort of mainstream buy-to-let lenders, and we do compete with mainstream buy-to-let lenders. We're not doing stuff that mainstream turned down. We're competing on price to them. So definitely at that lower end. It's obviously not without risk. If you want zero risk, then put your money in a bank or whatever. All peer-to-peer has an element of risk, but certainly because of the asset, it's not because we're clever or smarter. It's just the asset we've chosen. Buy-to-let and sensible LTVs. Is a much lower risk proposition in terms of lending than others, and you can see that when you look at banks and how they apply capital, or how they have to apply capital, and how they have to put in expectations of losses. What they do against their buy-to-let portfolio is a lot lower than they would under their consumer unsecured consumer unsecured loans, their business loans or whatever. So, what I'm saying is not just my opinion. It would be the same opinion of the PRA and most sort of heads of risk of banks that lend across a number of asset classes.
So, give me the number 1 to 10. 1 being the lowest, 10 being the
We're
riskiest.
either 1 or 2.
You're either 1 or 2.
We're somewhere between 1 and 2. I suppose.
Okay. The emails that I get, John, from the readers, financial thing, the one thing that turns them off about Landbay, sometimes they are rate chasers. They want to get the most returns for their money, and they look at Landbay on the lower side, and some of them are reluctant to invest because maybe they think the risk isn't worth the returns. Tell me what you think the benefits are if you were telling a potential investor. What are the benefits of investing through Landbay at these lower rates rather than sort of chasing the 10, 11, 12%?
Well, it's linked to that first point around risk. The less risk you take, the lower the return, in very simple terms. But it's also those returns should be less volatile. So you're not going to get 5-6% with us. But at the same time, we think we can weather the storm very well. We don't expect material losses in our portfolio. It's not to say they couldn't happen, of course it is. But actually, if you're getting, we're going through in 2019, we're in a very low interest rate environment. When you think about the how much it costs people to get a mortgage, how much it costs people to get a consumer unsecured loan. Assuming they're creditworthy, interest rates are at record lows. If you look at them in real terms, after inflation, they're at zero or negative in some perspective, and that's for the borrower, let alone the saver. And we obviously price our loans, and we clearly target prime borrowers. I mean, we are not targeting borrowers who banks are turning down. We're competing directly with banks. We're looking for people with clean credit history who have got a track record in buy-to-let. And so therefore we are lending at competitive rates. And we've purposely gone after prime borrowers. That means we're lending at lower rates than if we went under subprime borrowers in some terms. And therefore the rates our investors get is lower.
Yeah.
And I think for investors, they have to choose where they sit on the risk spectrum. And therefore the higher the returns means that actually they're more likely to get defaults, they're more likely to get arrears, those returns are going to be volatile. Some investors will put it all in high risk, some all in low risk, some may spread it around a bit and have a sort of portfolio approach. I suspect that that last solution is for most peer-to-peer investors is probably the right thing to do.
The diversification, yeah. That's something I always preach to people. Look, diversify in that way you won't be too shocked if something bad happens to a company or a batch of loans that you own. So
exactly.
John, so tell me, what's the single biggest challenge that Landbay faces 2019 right now?
2019, I think we're in, despite all the challenges in the market, not the market, the economy around Brexit. The UK economy has performed phenomenally well the last 2 years, and you look at unemployment figures, and so for us, and also we're in a very competitive environment still. So what you often see when there's uncertainty is actually competition dies down a little bit, if that makes sense. That's not the case. So we're in a very competitive market for loans, i.e. for competing against banks, etc. And getting our proposition out there with intermediaries, and also for talent, for people to come and work. We're based in Victoria, London, so it's a pretty nice place to work. But still, it's a competitive market to hire in all parts of the business, whether it be in tech, whether it be in credit, whether it be in sales, finance, marketing, etc. And so I think that's probably the biggest challenge, and potentially with Brexit that could become harder if we if we do reduce immigration materially, or we want to, then I suspect that is it's going to be even harder to attract talent, because probably around about a third of our workforce is EU nationals, or now some of them may have UK passports and rights to remain, etc., etc.
Right.
And to be clear, we don't expect any of them to get thrown out. But obviously, going forward in terms of attracting talent, we want the London and the rest of the UK to be an attractive place for people to come and work, whether they be from other parts of the UK, or whether they be from overseas, whether that be Europe or other countries outside Europe.
Yeah.
And I hope the government does realise that actually for businesses like ours, but actually for most businesses, being able to hire skilled, intelligent, articulate workforce is very important. It's probably one of the most important things for any business.
Right. Okay, so if you're looking for work and you're a bright-minded individual, you could always come to Landbay.
Yeah.
I don't like to use the word mistake, so I call it growing experiences. What's the one lesson, that you've learned going back from 2018 to now moving forward, the Landbay is going to use to improve their business? Maybe something that happened last year or something you learned from?
So there's no one thing. I think we made our mistakes probably not so much 2018, but probably 2016, 2000, and we luckily we haven't made those really in credit. I think the one thing we consistently find is everything just takes longer than you expect. So now, certainly in our forecasts and plans, our assumptions are different around how long things take to do things, whether that be hiring, moving office, launching product. Everything, everything just takes a little bit longer than you think. So I think that's probably one of the main things. I think we're constantly seeking feedback from borrowers, brokers, from investors on our, on what we do. And generally what we found is there's not one thing. There's lots of little small things, and we iteratively just try and tweak things and make them slightly better. Whether it be borrowers or investors, they probably haven't seen a sudden change and think, suddenly you've changed everything and it's better, or hopefully not worse. Yeah. There's been generally little small things that we've introduced to hopefully make, whether it be investing in Landbay or whether it be borrowing from Landbay, either just a little bit easier or a little bit better.
So you're tweaking it, making things better. Okay, last question, John. Is there anything that, as far as Landbay's products or news, that you'd like to tell people about this, maybe upcoming or changes to the products you're going to be offering, or anything different?
In short, no. We're a big believer in doing what you understand and specialising. Obviously, the buy-to-let market is a huge market. We're still a very small player. To put it in perspective, I suspect this year we will end up being around, in terms of lending, around about 1% of the market. Maybe slightly more, but that sort of level. So we've still got a lot that we can grow, and we think we know a lot about buy-to-let now, and it's far better we just concentrate on that and do more than suddenly think, we're going to do development lending, or we're going to do consumer lending, or something different that we don't really know anything about. And we think that's right for investors. And going back to what you were saying earlier about our returns, we like to be that, we are what we say on the tin, and the returns are not as high as they are on other platforms, but hopefully people know what they're getting. You're investing in buy-to-let loans, and suddenly you get to a point where, actually they do a bit of this, bit of that. We think that's a less compelling proposition for investors, where you suddenly think, what am I investing in? Yes. So if people like the idea of investing in buy-to-let loans, then they come to us. If they don't, then they don't have to. And likewise for borrowers, they know the market we serve. Our credit guys, our sales guys, just very, very focused.
Absolutely. So stick to what you know, as my dad always said. Yeah. Okay. Anything else that you want to share, or we covered everything?
Well, thank you very much for having me.
Sure. There you have it. I'll leave the link below. Check out Landbay if you're looking for a relatively low-risk peer-to-peer company to put your money. Landbay is worth a look. Thank you very much, John. I'm going to do a quick office tour of Landbay with John.
We've been in this office since May 2018. We're like to take another floor probably around about May this year. So we're 60 people. This has 60 desks in. Some of our sales guys aren't office based, but we'll grow out. So this is our sort of lunch area.
Who's the champion of the football?
Don't know, not me.
You don't play it.
Okay. We've got a couple of small internal meeting rooms there for calls, etc. There's a small little balcony. Yep. Out there.
The R&R.
Which we use in the summer occasionally.
Not now.
Exactly.
Yeah. So maybe if you can just explain maybe what the different areas that people.
So this is sort of sales. This is sort of sales when they come in, which is not very often. You're on video. This is all lending here. These three desks. So underwriting and credit. And these next two banks, sort of ops and finance and marketing. And then around here, this is from this desk on, all the way down to there is tech.
Oh, this is all
So
tech.
it's all tech, and then there's another meeting room, boardroom at the end
They have a
there.
lot of tech.
Yeah.
A lot of tech. Takes a lot to
Yeah,
keep everything running.
exactly.
So there you have it. That's Landbay, and they're all busy creating new business.